Marin Katusa's new book, The Colder War, is now on bookshelves. Marin pulls away the curtain on how Russia, China, and Iran have come to dominate the global energy stage and put the petrodollar to rest once and for all. Find out why Dr. Ron Paul and critics alike are calling The Colder War one of the most important books you will read this year. Visit PalisadeRadio.com and enter our weekly drawing to win a free signed copy of Marin's book. That's PalisadeRadio.com.
Welcome back to Palisade Radio. This is your host, Colin Cattell. We're starting a new year of interviews and kicking it off with an interview from my good friend. But before we get started with the interview, I want to announce this week's winner. For the free book giveaway, we're giving away free copies of Marin Katusa's New York Times best-selling book, The Colder War. Bernard from Los Angeles is the winner this week. Thanks to Bernard and everyone else for signing up. It's been a huge success. And we only have 1 week left in the book giveaway, so visit PalisadeRadio.com and sign up. Now on the line with us today is the publisher of GoldStockTrades.com, Jeb Handwerger. Jeb, thanks for coming back on the show.
Thanks, Colin. I want to wish you and your listeners a happy new year, 2015. It should be a prosperous new year, and I'm appreciative of what you're doing with highlighting the resource sector.
You know, there aren't too many people left doing that right now, and that's something we were talking about before the call. Gold and silver are both trading down towards their bear market lows. Gold stocks, as represented by the GDXJ, are extremely undervalued, with their prices indicating investors' fear for further downside in the metals. And every indicator I'm looking at says a major rally in the junior stocks is right around the corner. But before we got on the call, you mentioned two possible scenarios as we hit January. Can you talk about that?
Well, you know, we've had a very interesting 2014. Last year, we had a similar tax loss selling phenomenon going into December. Then we had a very powerful bounce from pretty much end of tax loss selling at the end of December of 2013 all the way to March, PDAC pretty much, of March 2014. 3-month, very powerful tradable bounce. But then we got into the summer where it based out, and then we got into this crash in the resource sector pretty much due to these geopolitical events globally with Russia that's caused a massive sell-off in the resource sector. So the two scenarios now is we've recently seen we're just getting past this volatile 2014 tax loss selling season. We've seen a crashing oil price. We've seen a rising U.S. dollar, really putting pressure on junior mining investors. The mining sector's hated, the major miners are hated, and within the hated sector, the junior miners are the most hated of all. So very few investors left. Typical signs of a bottom. Remember, back in October of 2011, you've been reading my material for many years, Colin. I have a video that highlighted the S&P 500 and a potential bullish reversal in the S&P 500 back in October of 2011, when not a lot of investors were buying S&P. They were chasing gold higher. And that's when I was nervous on gold, when everyone was getting overly aggressive in gold. Now we have the exact opposite. No one wants to touch gold and silver. Everyone's chasing the S&P 500. Look at the mainstream media, the front headlines. U.S. stocks. People are taking margin to buy large cap dividend paying stocks. So the equities are rallying, the large caps, not the small caps. The venture is hitting a major low, decade low, while the S&P 500 is at way above 2000 pre-credit crisis highs. So I would never have expected in a million years that back in 2007, when the venture was 3,400, that it would be trading at 650 in 2015. Could never have expected that. And the S&P 500 is in parabolic new high territory. And this is really similar. Where have I seen this before? When I started in this business, in the mining business, which is in the late 1990s. That's when I really started investing and managing money. And I noticed this huge divergence between the NASDAQ at the time and the junior mining sector, which was in a 20-year base. Um, and that was the last time you saw a huge divergence like this. At that time, similar to today, no one really wanted to touch the junior mining sector. Very few investors. They favored the large cap Dow dividend paying stocks at the time and the tech names, the dot coms. And that was at that time, that was popular. But the best investment at that time was to avoid the dot com stocks and the tech stocks because we had a crash, a dot com bubble crash. And if you were invested in the junior miners at that time, or just invested like the HUI or the XAU, you would have made quadruples for the next 7 years. So we're at a very similar time to that. But the two scenarios are this. We're at a very deeply oversold level. We could have a big January bounce like we had in PDAC, or we could see a continuation of this capitulation that we've had over the past 4 months that goes into January, not getting the January effect. That's less odds, but what would it cause is more severe capitulation. What we've seen in the venture the past 4 months, I have not seen a capitulation like this since the 2008 credit crisis, and pretty much in my entire career. So this is really historic right now. So the worst thing to do is to chase investors into the S&P 500 or what everyone else is doing, and focus now at this time and do what no one has the courage, has the backbone to do, which is to stick to this sector. It's very cyclical. It's going to make a comeback. It made a comeback in 2008. Made a comeback in 2000. The XAU, went from 40 to a high of 220 in 2011. It's had sell-offs. It had a sell-off in 2008. It had a sell-off back in 2000, and it's back at those levels now. But these are where the greatest opportunities really lie right now, is in the junior gold sector, the most hated of the hated sector, but really may have the greatest long-term opportunities. Especially, none of the problems have been solved in the U.S. or Europe with regards to the debt problem. The debt's continuing. We have not solved that. We're just trying to solve the problem by more and more debt. Eventually, the piper needs to be paid. When that time comes, people are not going to be chasing dollar and treasuries like they're doing right now. They're going to be looking for real assets, and they're going to be coming to our sector.
Well, here's what I find most confusing, and investors don't understand what's going on with the markets and how the equities can be reaching all-time highs while commodities are at such lows. The narrative of a growing U.S. economy does not mix well with low commodity prices. All the inputs going into the economy, the commodities, are dropping, which would lead me to believe the demand for those items is not reflecting a booming economy. How does the economy grow and demand for commodities drop so much?
Well, Colin, part of in my premium service, and when people go to my website, they can see that I use a lot of charts to study the economy, and I use a lot of ratios. And it's important to use ratios because you have to understand how to judge value. And if you're judging it in terms of dollars and treasuries, it sometimes is a distorted picture of really what's under the underlying economy, how it's performing. For instance, right now, we've had a major oil crash, 50% correction in 3 or 4 months. When you look at that in terms of gold or in terms of uranium, when you compare gold not just in dollar terms or in treasury terms, but gold in terms of oil. You see that the gold to oil ratio is hitting a 3-year high. This is very good for the miners because most of their cash costs are based on oil, especially the big miners. So it's very important to understand and to study how a commodity is performing, not just against the dollar. Because what's happened is, with what's going on right now with your question about this S&P 500 and the U.S. dollars skyrocketing, and the commodities are so low. What happened is in the middle of 2011, the U.S. kind of stalled their QE. For a while, they were pushing the QE more than the other countries. Then Japan and Europe accelerated while the U.S. slowed down. So this led to a flight of capital to U.S. dollars and U.S. equities. And since commodities are priced in U.S. dollars, copper, oil, precious metals have been declining in terms of dollars. But the real issue is here that all the currencies are weak. It's just that the U.S. is a little less weak right now because of what's going on with the banks and than the other currencies. So the dollar doesn't really have the fundamentals. And so from 2011 until today, we've seen this decoupling of this rising U.S. dollar equity market. It appears that the economy is better because the natural resource market is declining, but that's not the reality. We've seen this sort of play out before, and the reality is that the negative sentiment on our sector is at an all-time high, meaning pessimism is very great for our sector. There's panic selling to chase this high stock market. We've seen how this plays out before. We've seen the dot-com bust. We've seen the credit crisis, 2008. I'm not a believer that the U.S. is going to start raising interest rates when you have a crashing oil price and a rising U.S. dollar. I think the next surprise, all the investors think that interest rates are rising in 2015, but QE4 actually might be the next option, or even negative interest rates right here in the U.S. It's happening in Europe right now. Who's to say it can't happen here in the U.S.? So I'm going to stick to the junior mining sector, and I think that investors who are concerned about these negative rate policies globally, and if it's coming here, should really begin to develop a buying strategy of the top junior mining stocks in our sector.
One of my favorite investments right now is uranium. When I get particularly excited about uranium is when all the investors in our space are focused solely on gold. Nobody's talking about uranium. You mentioned before the call that the uranium to oil ratio is showing uranium strongly performing, even uranium to dollar, because the spot price has gone up considerably over the past few months. And these uranium stocks have not reacted yet. We both know when uranium stocks react, they go up a lot faster and a lot stronger than even the gold stocks. Can you talk a little bit about uranium right now?
Yes, Colin. One of the charts that I showed my readers is Uranium Participation Corp, which can be traded as U on the Toronto Stock Exchange, which is sort of a barometer for the uranium spot price. It sort of matches the performance versus light crude oil spot price. And since this collapse, uranium has been a safe haven, believe it or not, even though no one wanted to touch it. And I've been speaking about it, and you've been speaking about it for a while. And actually, that ratio of uranium to oil has doubled since July. So that's a very powerful, and it's a major breakout of uranium versus oil. Now, why should there be this big breakout fundamentally? The realization is we're moving towards a nuclear as a baseload, and there's more and more of a movement away from over the next generation from fossil fuels into nuclear and into energy sources that have clean emissions. So that's the fundamental reason, and the policies that China and the U.S. Recently announced with their carbon goals by 2025. But the significance of the uranium versus oil is quite exciting, and we're seeing Japan turn back on reactors. We're seeing the U.S. Building reactors, and in a market where you're seeing such a collapse in the resource sector and in oil, for uranium to perform like this, even with a rising dollar, indicates to me that there's some smart buying coming in at the end of 2014. So again, it's a very important sector for investors to start researching the highest quality, top junior uranium miners, which are being traded at historic lows.
The absurdity of the situation with the uranium stocks can best be highlighted by looking at the per pound price of reserves in the ground compared to the market cap of a company. So for example, U308 Corp is a company that we've both talked about in the past, and I never thought it would get this cheap, but you're looking at 14 cents per pound of uranium in the ground. Bayswater Uranium is a company I just participated in the placement, and they're trading at 38 cents per pound in the ground, moving towards production. I think we're going to look back on this and say that was one of the best opportunities in the last 10 years to make 100 times your money. One last thing to touch on, the gold to oil ratio. Why is that important for especially the major producers?
The gold to oil ratio is very important and sitting at 3-year high. And when because when gold was rallying in the past, oil was also very high priced, so it was cut into the profits of the majors. But when you have a very powerful gold oil ratio like this, that is beneficial because the gold price is holding up, but their costs are going to be drastically reduced. So that's something to keep an eye on. But just getting to your point about the nuclear, which I forgot to include, and I agree with you that there's one of the ways to look at the junior miners is looking at their resource base and just looking for pounds in the ground, because eventually when this uranium market comes back in, having that leverage is going to be quite valuable to institutions, and there's very few names, so that's very important. But also the recent victory of the Republicans had a huge victory, taking control of Congress, and this could actually give boost to nuclear power. And for years, the Democrats blocked funding for Yucca Mountain, which was a nuclear waste site that's critical for spent fuel, for storage of that. Now the Republicans can push forward Yucca Mountain, and once we start seeing the nuclear utilities, looking and getting into this sector, it's going to be a big boom, and I think that's something that investors should be monitoring in the first quarter of 2015.
Goldstocktrades.com is Jeb's newsletter. Everybody should sign up. There's a free version and the premium subscription, and they've both been very valuable for me over the past few years. Jeb, thanks so much for coming back on the show, and of course we'll have you back in a few months to see what's going on in the economy.
And thank you, Colin, for working so hard in our sector.
Thanks, Jeb.
Vladimir Putin is a self-made man. He did not come from money. He did not come from a royal family. He was your blue-collar boy who did well. Putin has positioned himself in the center of the chessboard in the energy matrix of the world. Right now, Putin and his allies in China, India, Brazil, all of the emerging markets are aligning together to fight the European Union, the IMF, and America. Eventually, the rest of the world will realize that Obama and America are hiding behind this curtain with no powers anymore. Putin specifically has positioned Russia to become a global superpower, and America has never been more vulnerable than it is today.